Now let's bring in our panel. Invesco's Brian Levitt, Bartlett's Holly Mazzocca. Guys, welcome. Brian, I think you've tended to say that peak uncertainty is a really good time to buy, but policy uncertainty with what we see happening now in Iran, besides everything else with the disruptions around software, are we at one of those moments? Can we buy?
Hard to say if we're exactly at peak uncertainty, although I suspect we will get there within a shorter time horizon than some may suspect. Look, there's challenges here, but ultimately we came into this with a relatively good economy, with inflation relatively contained, economic activity picking up. And so you have a good backdrop. The challenge is how long does it persist? And so if, in fact, last week was the peak in the geopolitical risk index, then, yeah, the next 12 months historically, history would suggest should be good for stocks. I don't think any of us know if that's the actual peak, but I suspect we probably will be getting there sooner rather than later if last week wasn't it.
Holly, any of this throwing you off of your 2026 playbook?
We are recognizing that risks to that growth story are mounting. And one item that is new since the beginning of March is some of the revisions in the data that's coming in. So to Brian's point, we came into this year with a pretty strong foundation, but especially the labor market has weakened pretty significantly. So that's the big question for investors right now, is just being realistic that the overall risks to that continued growth story are higher today than they were just a few weeks ago.
So, Brian, how much do rates matter, and how much of that rate picture for stocks is being driven by questions about the labor market? We got some numbers recently that raised some concerns there versus, okay, now we got this oil shock, which could be inflationary if it lasts longer. Of course, the administration is saying it won't last too long.
So here's the good news. The good news is the market came into the year expecting 2 to 3 rate cuts. We've now basically priced that out of the market without substantial disruption to the S&P 500 market, down overall, 4 or 5%. So we've already priced that out. My expectation, I mean, prior to the war, the 10-year rate was falling below 4, had fallen below 4%. I mean, that's Holly's point about a weakness in economic activity. And so my perspective on that is that weakness in economic activity is actually going to be good for equities because the Federal Reserve is going to lower interest rates and steepen the U.S. Treasury yield curve. So that was the view. The market has now priced it out. But if you look at the way the market's been behaving since the start of this conflict, you have some things going in the opposite direction of what you want, but not meaningfully. Credit spreads out a little bit, inflation expectations up a bit, the forward curve on oil up, but still, pointing, still down in 12 months, and then finally, that the dollar has strengthened, but not meaningfully. So all of that suggests some challenges, but none of it is pointing towards end of cycle. It's a market that continues to believe we will get back on the path that we were on, really just, 16 calendar days ago.
Or, Holly, are we jumping on a rickety bridge and thinking, oh, it's held well so far, but eventually one of these things is going to break through? I mean, how do you handle this uncertainty in a portfolio? How do you recommend that investors rebalance during a time like this?
Yeah, this is where it's really important to separate the headlines from the underlying data. And when we look at where we are, we recognize that corporations have a runway to continue to do pretty well. Earnings expectations for the remainder of the year have held up well during this period of conflict. And a lot of that comes down to this expectation that you can see productivity from AI support margins, and you can see opportunities for continued investment in capital expenditures. However, we're not seeing the expectation that labor will recover in a meaningful and healthy way. And some of these headlines are giving consumers concern about what their jobs mean for them and how much stability is there. So we're watching closely how the consumer reacts to all of this. It's not just the real dollars and cents they're spending on oil, it's how they feel about the dollars and cents that they're spending at the gas pump, that they're spending on healthcare, that they're spending on insurance, and seeing if that consumer sentiment slip spills over into realized consumer spending declines.